Warren Buffett's Cigar Butts strategy, the one he used before he met Charlie Munger. The cigar butt net-net investment strategy was one of the early investment approaches used by Warren Buffett before he met Charlie Munger. This approach involved finding companies that were trading at a significant discount to their liquidation value, which meant that the company's assets were worth more than the market was valuing the company as a whole. Buffett's cigar butt strategy was based on the idea that even though the company might be in a difficult position, there could still be value in the assets that could be sold off. He would look for companies with a strong asset base, but which were undervalued by the market due to the short-term issues such as declining sales, operational inefficiencies, or financial difficulties. Buffett's approach involved buying these undervalued companies at a significant discount and then holding them until the market recognized their true value. Once the market value reached the intrinsic value, he would sell his stake and move on to the next undervalued opportunity. This approach allowed him to make profits on investments with a relatively low risk, as the underlying assets of the company provided a margin of safety. However, Buffett eventually shifted away from this strategy as he began to focus on investing in high-quality businesses with strong competitive advantages and long-term growth prospects, which he believed would deliver sustainable returns over the long run. He realized that investing in cigar butt companies was a short-term approach that required constant monitoring and didn't necessarily provide sustainable growth opportunities, explaining the working capital being higher than total liabilities, or the net-net. Working capital is the difference between a company's current assets and its current liabilities, and it represents the amount of capital that is available to fund the company's day-to-day operations. In general, a company with a positive working capital balance is considered to be in a strong financial position, and it has more current assets than current liabilities to cover short-term expenses. If a company's working capital is higher than its total liabilities, it means the company has a significant amount of excess capital beyond what is required to cover its current obligations. This can be an indication of a strong financial position, as the company has enough liquid assets to cover its debts and still have capital left over for other purposes, such as investment in growth or paying dividends to shareholders. However, it's important to note that having excess working capital is not always a good thing. If a company is holding too much cash or other liquid assets, it may not be using its capital as efficiently as it could. In some cases, it may be more beneficial for the company to invest its excess capital in growth opportunities or pay down its debt, rather than letting it sit idle. Warren Buffett's investment strategy has always focused on finding undervalued companies that have strong assets and long-term growth potential. In the early days of his investment career, he used a strategy called the cigar butt approach to identify undervalued companies. The strategy involved buying companies that were trading below their liquidation value, meaning that their net current assets, which is working capital minus total liabilities, were greater than their current market cap. The current market cap is another way to measure the value of the company by multiplying the share price by the total number of shares. Buffett saw this as an opportunity to acquire companies with a margin of safety. If the company's value declined, there would still be enough assets to cover the investment. He would then purchase these companies at a discount to their liquidation value and wait for the market to realize the true value of the assets. Once the market value reached the intrinsic value, he would sell his stake and move on to the next undervalued opportunity. Buffett applied this strategy to several cigar companies such as American Brands and Brown & Williamson, which were trading at a significant discount to their liquidation value. By buying these companies at a discount, he was able to acquire strong assets such as inventory, production facilities, and brand names, at a fraction of their true value. This approach allowed him to generate significant returns on his investments, as the market eventually recognized the true value of the assets and the company's market cap increased. Overall, Buffett's strategy of buying cigar butt companies with a market cap below their net current assets, which is working capital minus total liabilities, allowed him to identify undervalued companies with strong asset bases and generate significant returns on his investments.